Private equity giant Blackstone out with first quarter results a short time ago. The company reporting earnings per share of 98 cents. It's 2 cents better than expectations. Revenue topping $2.5 billion from one of the company's performance and the broader economy. We want to bring in Jon Gray, president of Blackstone, chief operating officer. Stock, we should say, off marginally on the back of that news. Jon, good morning to you.
Good morning, Andrew. Great to be here.
So let's talk about these earnings, and I want to talk about it in the context of what you're seeing in the broader economy, given that you have your fingers in so many different businesses, in the real estate business, through your portfolio of private equity companies. These were good earnings. I know you've been quite positive on where you think the economy is, so just grade it for us.
So maybe I'll start with the quarter, Andrew, because it was a good start for us and for our clients, which is the most important thing. We delivered for shareholders as well. What I'd say is we're seeing some positive trends that are good for our business. First, transaction activity has really picked up. You see that in credit markets, availability of debt capital. The equity markets have been strong, something your viewers know well. That's good for our business. And then we've seen an increase of flows into some of our products, particularly in the private wealth area. Individual investors appreciate the performance we've delivered, market sentiment improving there. And then another area that's been really robust for us has been private credit. Credit, both for corporate and real estate, for us is now over $400 billion. We've crossed over $200 billion of capital we manage for insurance companies. So we're seeing a lot of momentum there. So we can talk about the economy. I'm happy to do that. But we feel very good about the way the business is trending today.
In terms of those different products, private credit, as you said, a lot of big inflows. What kind of expectations should investors in those funds expect in terms of returns?
Well, it's really a range. You know, we do some things that are non-investment grade oriented. And in those products, you're seeking to produce, let's say, low double-digit returns. But a lot of what we're doing, particularly for insurance companies, some pension funds now, investment-grade private credit, and there you're trying to produce a premium over what they can get in liquid fixed income. And so far, if you look over the last year or so, we've produced about 200 basis points over what you could get in liquid fixed income for A-rated credit. So It's a relative return, but we've been able to deliver a premium because of the direct-to-customer model we have in private credit.
What are you seeing in terms of inflation and the strength of the consumer, both on the enterprise side and the consumer on the retail side? We obviously are debating where we are really in this economy and frankly, what the Federal Reserve may or may not need to do as a result.
Well, it's interesting. I was listening to your discussion. I want to give the Fed a little more credit here. I think their policy has been effective. We're seeing in our portfolio, which is really large, 230 companies, 12,000 real estate assets. We're seeing inflation continue its downward path, although the pace of that disinflation has slowed, which Fed officials have noted. When we look at input costs at our manufacturing companies, pretty flat. Similarly, apartment rents, pretty flat. Hotel room revenues, flat, in some cases negative. And when we look at wages, if you went back a year ago, they were running about 5% up, now about 4%. So I think the Fed's going to achieve more of its goal. It may take a little bit longer, but I think that's a real positive for investors.
We were talking to Don Peebles before about commercial real estate. I want to talk about BREIT in just a moment. But broadly on commercial real estate, as we talk about 4-hour work weeks, as we talk about hybrid work, what was the company that we just talked about this morning who's now going back to 5 days a week? Where do you see things? Have we bottomed out?
Well, in real estate, there have been a couple of big headwinds. One of them you're noting. In office buildings, remote work has really been a headwind. It created a lot of excess capacity and put pressure on rents and values. We've also had this rise in interest rates that's hit valuations across the board, regardless of asset class in real estate. But I think that's what's happened. Most of that has been incorporated in the market. You're going to continue to get tough headlines from transactions that were financed in a different world where there are maturities or buildings that vacate. But we like to look forward, and what's happening on the ground today is encouraging. We've seen the cost of capital for real estate come down a bunch. The commercial mortgage-backed securities market had a 5-fold increase in issuance, so debt capital is much more available. And really importantly, long-term, new supply has come down. So building of new warehouses starts are down 80%. New multifamily apartments down 50% from their peak. And to give you a sense of how we're thinking about things, we announced 2 big deals in the quarter, one for $7 billion, one for $10 billion, Tricon Residential, Air Communities. And we believe it's a compelling time to invest in commercial real estate. You need to do that before the all clear sign. People tend to wait till all the bad news works its way through the system, and often that may be too late.
Can we talk about the BREIT product? Because there's so many questions about it, so many headlines about it over the past several months. And we talked to Don Peebles again this morning, and we were talking about just the valuations of that product. You have brought valuations down slightly, but on a relative basis to just about every competitor of yours in the same space, the delta between your valuations and their valuations is sometimes 5, 6, 7%. How do you justify that?
So we're incredibly proud of BREIT. We started raising discount rates and cap rates, basically lowering the valuation multiples pretty significantly well before others. And that's definitely been reflected in our values. Last year, we had slightly negative performance. I think the key differential has been the growth in cash flows in our portfolio where we chose to invest. We have very little to almost no office exposure, no regional malls. We own within BREIT the fastest growing data center business, we believe, in the world in QTS. We own a very large, fast growing student housing business, big exposure to logistics, a much stronger sector. And I think when you think about how do we justify valuations, the most important thing is we've sold $18 billion of properties over the last 2 years at premiums to our marks. So we feel incredibly good about our valuation process and what BREIT owns and how we've positioned that portfolio.